Hey everyone, it's Evan here from the Trade Risk on Friday, April 6th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So stocks sold off this week. It was the second highest trading volume week that we've seen this year. It did come on a decline. Many people are going to look at this as a distribution week, but very important, we still managed to hold on to support. That is critical. We briefly undercut it and then bounced back above it. We're going to talk about that in today's video. And really, you know, the technical structure did not change much this week, but energy is being built up in the market here. We are at a decision point. We are frustrating people, longs and shorts. Are we going to break through the support? Is the market going to find support here? Are we going to bounce higher like we did back in early February? That's what we're all waiting on. That's what we're going to discuss in this video, so stick around. All right, let's jump in here with the S&P 500. And before we do, just to qualify, as I just recorded that intro there saying it was the second highest volume week. That was for the S&P 500, so the SPY ETF here. I know if we look at, I don't think the Russell 2000, it was the second highest. I think the NASDAQ, yeah, or at least the Qs, this was the second highest weekly trading volume of the year. So just to qualify that, some of the other indices may not have hit that mark. But with that said, let's jump into the technicals here. So the S&P 500, let's go to the cash market, and we're looking at a weekly chart. So we're going to start our analysis here. We're going to just talk about this big picture once again. Every bar in this chart represents 1 week worth of trading. This is a weekly time frame, and this is the S&P 500 cash market. And take a look at this week's trading. It was a wide range week. We have these wicks kind of on tails on both ends here, all the way down to 2550 or so, and then all the way up to 2671, over 100-point range in the S&P 500 this week. And ultimately we did close down 1.38%, 36 handles here in the S&P 500. And take a look at where the bottom tail kind of undercut and really took place at. It was at this critical 2016 start of this trend line here. We talked about this in our midweek video, so I don't want to go too off in depth here, because if you've been following these videos, then we've been talking about this zone for quite a while here. But I think importantly is we did manage to hold on. We did manage to hold last week's lows and the lows from the end of March. That is constructive, but we are by no means out of the woods right now. We are below a 20-period weekly moving average, and the 8-period exponential weekly moving average is about to get a bear cross to the downside. They are above price. That is what we would consider bearish alignment. Those are markets you want to be very cautious in, particularly when they are occurring or when this is the formation on a longer term chart. So right now, as we look here at the big picture for the S&P 500, really for all the markets, we're just being sandwiched in here. We have resistance up top here. We got price pressure coming down, and then we have this support that is trying to hold. And right now, what we really are seeing here is the significance of this level and the indecision at this level as well. We are really sort of moving all around. This was a messy week. It was just filled with 1% plus gaps up and down this week. Fairly nauseating as a trader. I'm thankful that I'm an end of day trader and I don't have to really pay attention too much to this intraday noise here, because that's what this really is. There's a lot of noise here. There are a lot of shares trading hands, and the market's figuring out which way are we going to end up breaking. Are we going to clear through this support? Like we've talked about in our past videos, there is a nice big air pocket underneath this level. So if we start breaking below and convincingly start closing below 2590, 2580, I do anticipate that to be a very violent move with some ugly price charts and declines on that day if it happens. We did have a close scare earlier this week, right on Monday, to start off the session. We were down over 3% on the lows here on Monday. We undercut everything and then we reversed. And matter of fact, in our midweek video, we talked about if you're an active tactical trader, the fact that we undercut this support here, rallied back up into, you know, this general area here. There's 2583. We just barely held the closing lows here back from February 8th in the S&P 500. Then we had this little reversal on Tuesday, or this follow through to the upside. So we had the reversal that started Monday, we had the follow through on Tuesday, and we talked about it in our video. If you're active, if you're tactical, if you're really nimble, that might be a good spot to allocate some capital to play for a tactical bounce up to resistance. And we did end up getting that. We got a move all the way up to 2670 or so, so almost 50 handles up to the upside. And you know, if you were looking for more, I think it was reasonable to say, okay, let's see if this market can now carry us strongly into the end of the week. Let's see if we can get through this resistance. That would be important. This 2670 level. Let's go to the S&P, the SPY, just because I think a lot of people like to look at this. This 265 level, 266, however you want to draw it, this is the top end of our trading range for the past 2 weeks. And the 20-period EMA is right here as well. This is the decision point. Can we get above here and hold above resistance? That was the next step. We had follow through to this early week's reversal, bullish reversal. Now can we get follow through and break through some resistance and hold resistance? That's what we wanted to see, and that did not happen. Friday we came crashing back down into this range, 2.23% sell-off, and here we are again, the same song and dance. We have this range, 256 to 266. It's basically a 10-point range, a 100-point range, 100-handle range in the S&P 500, and we're waiting to see which side's going to blink first. Which way is this market going to break? And if you're looking at the moving averages here and you're looking at the previous trend in here, the most recent trend is still to the downside. And again, we have those moving averages that are declining and bearishly aligned. Therefore, we have to respect the bear thesis here that we still have selling pressure, and all of this energy that is being built up here, as messy and as noisy as it is, this is, you know, undoubtedly energy, and anybody who's buying in here looking for these looking for this support to hold, if we start to break down from there, we are going to have a new batch of sort of forced selling. So Tuesday, we talked about the tactical bounce. If you were active, you know, you could catch that move back to the upside. That trade is sort of over, right? I mean, you could still be in a position, still using this as a stop loss, right? So you could still be looking at, say, 253 or the lows from Monday as being your line in the sand. So potentially, you know, if you're buying support here and you're doing it smartly and responsibly with a stop loss, position size appropriately, then I think that is a, you know, it's a reasonable approach as long as you know where the exit door is. And for those of you who don't want to deal with this, then certainly you don't have to, right? We don't have to trade. We can wait until the market makes a decision here, either breaking down or finally breaking up and through resistance and holding resistance. I think that's ultimately the story here. That's what we're waiting for. Right now, the market is, you know, just in this playground area of about a 3 or 4% range. So S&P 500 next week, highs from this week and the lows from this week. I mean, that's pretty much it. If we look at the SPY chart here, again, it was a pretty wide range. We failed right at last week's high, so 266 to the upside. That's the level we want to see reclaimed and held. Otherwise, it's 256, you know, depending on how you want to draw it, 256 to 258. You know, if we start losing that zone, all bets are off. I think you need to protect yourself or be cautious if we start to get a close below there. So that's the general landscape there. And you know, let's leave one other narrative in play here, is that, you know, more sideways action can and, you know, might be the most reasonable thing to expect. So in other words, a whole nother week of this just mulling around back and forth, that might be, you know, what's in the cards for next week. It doesn't have to always be straight up or straight down. Sideways is always and generally likely the scenario or path of least resistance the market will take. So that is the S&P 500. Russell 2000, really similar here. The levels are just a little bit different, but we look at this weekly chart and we're just at this critical trend line of support, horizontal level of support. We're below the 20 period. We sold off a bit on higher than average volume this week, so we are at a decision point here, make no mistake about it. But we do have a nice tail at the bottom end of this week's trading. So again, we need that confirmation. We need to see short-term resistance taken out. We need to see resistance held above, and that'll give us more confidence to, to dip our toes into this market and test the long side. If you're real tactical, if you're active, if you're tier 1, you could still be holding some longs here with a stop loss at the week's lows, or underneath this trend line, whatever you really see fit. And the NASDAQ 100, arguably, one of the weakest closes structurally here on a relative basis, given the fact we almost closed right at last week's lows, almost underneath last week's lows. And this trend line here, which arguably probably isn't drawn super precisely on my chart, we are starting to break below it, but we do have this 156 level, which was important. So there's a lot going on here. Again, just critical levels all around, and it's very much in a wait and see type of mode across all, the spectrum here of the market. So I think that sums things up. Let's jump into some other markets here. We'll go to TLT next, which had a nice finish to the week, up 1%. Held that 20 period, kind of undercut here briefly. And if we look at the weekly chart, it was still down on the week, 66 bips lower. And it was a wide range week, but still, almost an inside week though. Looks like it was 129. No, it looks like we slightly poked our head above last week's highs. Almost an inside week, a very wide range week though. And take a look, that's not the most favorable alignment of moving averages here on the weekly chart. We're below a 20, above a rising 8 period. That shows there's some indecision there. We have a lot of supply back here from 2017, which is right above price. So TLT's stuck in a tough spot, but if the market does in fact roll over, there's only so much place capital is going to rotate to, and treasuries are probably going to be that one of those safe havens. So, it's kind of another wait and see type of mode, but this is again at sort of an interesting inflection point. This is where you'd almost expect the rally to start to fail right around 123. But again, if the market starts to roll over, maybe you got some other different dynamics going on there. So not an easy trade, but that trend short term here above the 20 period gives you some hope there. Good volume at the end of the week. We'll go to metals next. Gold still just consolidating in this big pattern. There's lots of consolidations going on here across even different asset classes. But if we look at gold, 48 bips to the upside, 0.5%. You can see just kind of still in this this coiling consolidation pattern here. We had this nice move up in December. We're just moving sideways now for several weeks. Again, a safe haven asset. Generally, when equity risk starts to really get elevated and stocks roll over, gold is another safe haven asset that you would potentially look at for rotation of capital into, and that might be the trigger here for this continuation pattern. If stocks start to roll over, maybe gold finally gets its breakout above 128. There's a lot of influence by what the dollar is doing at that point as well. So gold kind of multifaceted there, but I think ultimately still just consolidating here. Really needs a break above 128, starting to get closes above 128, and this pattern is set in motion. I still like it structurally, but it still seems like it needs more time. So that's gold. Silver, same kind of thing, moving sideways here, not as attractive as gold. I think gold is set up with that nice uptrend from the end of 2017. It's now in this potentially consolidation pattern. Silver here, much messier, right? Below an 8 and 20 period declining weekly moving average, but it is spending a lot of time. The selling pressure is sort of abated here, and we're just moving sideways. So this is fueling up, right? This is a lot of sideways price movement for silver, and we should be paying attention to see which way this ultimately breaks. I think the levels here are pretty clear: 1530 on the downside, 1590 or so on the upside. So those are metals. Let's go to oil next. Oil hit hard here at the end of the week, 2.5% to the downside. And really just continuing to the early week sell-off pressure as well, 4.4% to the downside here. This suddenly isn't the most bullish looking chart that we are looking at now. We have this kind of pattern, maybe this coiling here, got higher highs coming in, right? So we have the ultimate high, higher lows coming in. So we got the low here from early February, a slightly higher low here from March. And now let's see, can we hold another higher low here, or do we come crashing back down and kind of retest this March and kind of break down from this range? Otherwise, we have kind of this double top in play. So something to think about here. USO kind of at a decision point, an ugly way to finish off the week on high volume and selling off pretty much into the close. So not the most pretty looking chart here going into the end of the week. Some caution is advised there. And if we go to natural gas next, you can see this one's still kind of sleeping, moving sideways here. Volume is super light. Take a look here at the trading volume this week. It's about 30-40% of the 50-day average. And really, the 50-day average has been slowly declining this whole year, or, you know, really after February of this year when we peaked up here and this had this big sell-off. Natural gas has just been sleeping, and you know, I still think this market will be awoken. Maybe it's the second half of this year, but you know, I'm expecting some movement, some spark here to eventually happen in natural gas. But for now, not really seeing it. Above 22.75, below 21.75. It's pretty much your dollar range that I'd be looking at for natural gas. So that, I think, is everything for the major markets. Let's take a look here at the sectors. So for individual sectors here, we'll pull them up right now, and we're going to sort them right by the 5-day return. So the weekly return. And if we look at the weekly return this week, XLE energy is on top. This is the outperformer for this week. Take a look at this range here, all the way to the top at $69, all the way down here at $65, and we closed right where we opened out the week. So a lot of indecision, probably a lot of frustrated traders when you see a bar that looks like this. But look where this is occurring. It's just in the dead center of this 8-week range at this point. So we're still waiting to see what goes on here for XLE. It hasn't, you know, participated. You know, it hasn't made new lows from the February price here, where this really led to the decline. Was one of the first groups to really get kind of slaughtered here at the beginning of February, and it just hasn't done a whole lot since then. So we're still kind of waiting to see what happens, something to pay attention to. Utilities, second best performer this week. It was down just slightly on the week. You can see kind of an ominous looking pattern here. It's not the most attractive pattern here. You could almost look at this as some type of bear flag setting up for utilities, rallying into a declining 20-period moving average. So I wouldn't be so comfortable there. You know, the relative strength this week is nice, but again, we still want to see, you know, really $51. We need to see some of this recent damage get recovered, and we need to get prices moving a little bit higher. And then finally, our top three, rounding out the top three, was staples. So very much when you look at this theme here, it was a defensive theme. We get utility, staples, and energy. So, well, energy not necessarily always considered to be a staple, but you know, a little bit of a safety haven trade here with XLP and XLU rounding out the top two. This pattern looks horrible still. I mean, it's been crushed here over the past couple of months. A lot of momentum to the downside, maybe some more mean reversion upward, but it isn't too pretty. If we look at our bottom three indices sectors here, XLI. So XLI here is the third worst performing, down 2.05%. And take a look here, it's closing right at last week's lows, the last 2 weeks' lows. So this is kind of really looking over the ledge here and almost starting to make follow through to the downside. High volume distribution week here. This is a vulnerable sector, particularly in this weekly time frame. You know, you got about $70 down here. It would be the next pivot point to pay attention to if this continues to roll over. Technology. Technology also here in the bottom three. This is the second worst performing sector of this week, 2.09% to the downside. And you can see here on the daily chart, it's still just really messy. Kind of looks similar to the Qs, always does. High volume sell-off into the end of the week. It is still holding support, but it certainly is vulnerable, and it is below that 20 period. And finally, the worst performing is IBB here. I know it's technically not a spider sector, but biotechs were hammered this week. 5% on the decline here for IBB, and it's back to a very significant level. This $101 level, which has been holding since summertime of 2017. We've been above it. We broke out here on this big igniting bar in June of 2017, and now this could all be one big kind of topping pattern here for biotech. Basically, you know, 9 months, 8 months, 7 months of sideways action here. And if we start crashing below this $100 level, this does not bode well for IBB. You could also look at XBI, which is the equal weighted biotech, and take a look here. This is breaking that trend line. So here's the infamous trend line that we're seeing. across all of the major markets there that we looked at the top of the video, and XBI is kind of the first here to really start to make a significant, give itself some significant distance below that trend line, indicating that it did in fact break. It did break below 85. It was down 5.5% on heavy volume this week. So for a very risky sort of appetite sector, that does not bode well. Let's see if this is a leading indicator or if this is some type of one-off and the market, can hold itself together in some of these other sectors. So that is all I have for this week's video. Hopefully you guys managed that volatility okay. Thank you so much for watching. As always, you can subscribe to our YouTube channel Tuesdays and Fridays. Put out video recaps just like this, or you can go to thetraders.com on the blog. Everything gets always posted there on the homepage or the actual blog. So thanks again for watching, and talk to you next week.